Traditional stock options operate on a weekly rhythm. You place a trade and you wait days for the contract to expire. Crypto markets move faster. Because they trade around the clock, platforms now offer daily expirations, creating a new window to collect premiums every 24 hours. To capitalize on this daily cycle, we use a setup known as a short strangle. This strategy does not require you to predict a market breakout. Instead, it generates profit when the market remains within a specific range. You execute this by selling two separate out-of-the-money options simultaneously. You sell a call option to set a ceiling above the current price and a put option to set a floor beneath it. In exchange for taking these positions, you receive an upfront cash premium for each. The objective is simple. If the price of Bitcoin or Ethereum stays between your ceiling and your floor until the end of the day, both options expire at zero, and you keep the full amount of the cash you collected. This approach focuses on extracting daily yield by monetizing the hours when the market stays quiet, rather than chasing the volatility of a major price swing. While crypto trades 24/7, its most significant moves are usually tied to the opening bells of the US and Asian stock markets. These are the periods when institutional volume is at its peak. The optimal time to enter a short strangle is during the quiet window immediately following these major overlaps. Once the initial surge of global trading volume fades, the market frequently enters a period of relative stability. To set the trade, you look at the options expiring the very next day. You open the option chain for Bitcoin or Ethereum and look for specific price targets. This is a simplified option chain. The strike price is your boundary, and the premium column shows your immediate cash payment. Next, you look for an out-of-the-money strike on the call and put sides that each pays a premium of approximately $100. Avoid analyzing the chart for direction. The strategy is purely mechanical. Select the strikes where the premiums match at the $100 level. By entering the trade during the market's natural low-volume hours and matching these premiums, you increase the statistical likelihood that the options will expire without being challenged. Selling options involves significant risk. If the price of the asset moves violently past one of your strikes, the potential losses can be substantial. To manage this, you must use a setting called isolated margin. You manually switch the account mode from cross to isolated before placing the trade. Isolated margin acts as a firewall. It limits the risk to only the specific dollar amount you have allocated to that trade, ensuring that the rest of your account balance remains protected from a sudden market move. This protection allows you to use high leverage, often up to 200x, on the individual position. This keeps your actual capital requirement low, often putting only $10 or $20 of margin at risk per trade. The second layer of defense is the automated stop-loss order, which must be set immediately after the trade is executed. The rule for the stop-loss is mathematical. If you collected $100 in premium, you set the stop-loss to trigger if that premium reaches $200. This caps the loss on each side of the trade at exactly double the premium collected. These two mechanical rules, capital ring fencing and automated exits, apply institutional risk management to a retail strategy, keeping potential losses strictly defined. When the options expire the following morning, the trade results in one of three specific outcomes. Outcome 1, the market stays in range, yielding roughly a 25% return. Outcome 2, sharp movement one way hits one stop loss while the other pays out, breaking even. Outcome 3, a whipsaw hits both stops, causing a defined loss of your isolated margin. Because this trade generates a profit or a break-even in both flat and single-direction markets, the mathematical probability of a successful outcome is estimated at over 60%. Manually executing this strategy every morning requires a consistent schedule and disciplined scanning of the option chains. API mirror trading provides a hands-off alternative. These platforms allow a lead strategy to broadcast trades directly to connected follower accounts in real time. Linking an account to an automated leader handles the $100 strike selection, the isolated margin configuration, and the stop-loss placement automatically every day. Automation removes the influence of human emotion and the need for daily manual entry, establishing a system for background yield generation. To run this pipeline, you time the market's quiet hours, match the $100 premiums, and secure the position with isolated margin and stop losses. If you are looking for a dedicated tutorial on how to apply these strike selection rules specifically to Ethereum, comment ETH below. Systematically monetizing the quiet moments in the market offers a path to yield that does not rely on catching a single directional breakout. If this breakdown helped you understand the mechanics of daily crypto yield, like the video, share it, and subscribe to US